All right, let's just jump right in and shatter a really massive illusion on Del Al Street right out of the gate. The idea that profitability guarantees safety. Because it doesn't, not even close. Profitability ratios are great. They tell you how much a company earns, but they completely miss a much, much more terrifying question. Is this company actually going to survive? I mean, think about giants like Yes Bank, DHFL, or IL&FS. If you were just following their earnings reports right up until the actual year they collapsed, they looked incredibly profitable. The market was literally cheering. Retail investors were out there aggressively buying the dip, totally convinced they were getting this amazing bargain. But beneath the surface, the core engine of the business was dying. So today, we're taking profit, putting it to the side, and focusing purely on survival.
Look, as an investor, your absolute first job is to protect your capital. Growing it comes second. So think of me as your protective analyst older brother today. We are going to cut right through the flashy earnings reports, the carefully crafted PR spin, all that endless Dollar Street jargon, and we're going to uncover the true, unfiltered financial health of a business. Because honestly, if you can't confidently answer whether your portfolio companies will even survive the next 12 months, you aren't investing. You're just gambling and hoping for the best. So think of this explainer as, well, your essential survival toolkit. We're going to check the vital signs of a company. By the time we're done here, you are not going to be easily distracted by some CEO touting record profits if their underlying balance sheet is built like a house of cards. We're going to understand exactly how to spot trouble way before the broader market even catches on.
All right, here's our whiteboard plan for today. We'll start with survival over profitability, then look at solvency, the long game, followed by liquidity, the short game. After that, activity, which is operational efficiency. Then we'll break down the anatomy of a collapse and wrap up with a practical 6-step survival check. Let's get into it.
Part 1. Survival over profitability.
Listen, survival requires entirely different metrics than mere earnings. A business can show massive revenue growth and these incredibly healthy margins on its income statement, but if it owes a literal mountain of debt that it can't refinance, it's heading straight for bankruptcy. We really have to stop obsessing over the income statement and start interrogating the balance sheet. And this brings us to the two foundational pillars of corporate survival: solvency and liquidity. I want you to think of solvency as eating and liquidity as breathing. Solvency is your long-term survival, right? Can the company repay its total debt over the span of many years? Liquidity, on the other hand, is short-term survival. Can the business pay the bills that are due in the next 12 months? You desperately need both to live. Think back to 2008. A massive institution like Lehman Brothers was actually technically solvent in the long term. Their assets outweighed their long-term liabilities. But they died because they couldn't breathe. They became short-term illiquid, the credit markets panicked, nobody would lend them cash for their daily operations, and they just collapsed overnight.
Section 2 now, solvency, the long game. So solvency basically measures whether a company can survive a long, brutal economic winter and eventually repay all of its long-term obligations. Because when credit markets freeze, leverage kills. The debt-to-equity ratio tells us exactly how much leverage a company is carrying. And just notice the stark contrast between sectors here. The fortress-like balance sheets of FMCG and tech giants in India, incredibly safe. HUL sits at 0.05, which is essentially zero debt. TCS is right there at 0.04. Even a massive capital-heavy conglomerate like Reliance is operating at a highly manageable 0.45. Generally speaking, anything under 0.3 means the balance sheet is basically a bunker. But then look at the pre-collapse numbers of companies like DHFL, running at a fatal leverage of 8 times equity. Yes Bank was over 12. Now, to be completely fair, banks naturally run higher leverage because, well, their entire business model is borrowing money to lend it out. But even for a bank, these extreme double-digit numbers were massive red flags screaming that risk was totally out of control. Red flags that the broader market just completely ignored until it was too late. But wait, the total amount of debt is only half the story. The real danger is whether you can afford the monthly payments. And that brings us to the interest coverage ratio, which is simply your operating profit divided by your interest expense. If this number falls under 1x, man, treat that as a blaring, flashing siren. It literally means that the company's operating profit cannot even cover its basic interest payments to the bank. They're essentially using a brand new credit card to pay off the minimum balance of an old credit card. It's a mathematical death spiral. Seriously, if you ever see a non-financial company in your portfolio with an interest coverage ratio below 1, you are looking at a financial crisis unfolding in real time, and you need to run the other way.
Moving on to Section 3, liquidity, the short game.
You could have a brilliant, foolproof 10-year master plan, but hey, if you can't make payroll tomorrow, you're dead. The current ratio measures this exact short-term survival by dividing current assets by current liabilities. Now, while a ratio above 1.5x is generally considered very healthy, you absolutely have to understand the specific industry context before making a judgment call. TCS, for instance, has a massive 2.5 ratio, very comfortable. Asian Paints is quite healthy at 1.5, but then you see a giant like Hindustan Unilever sitting at 1.2. So is HUL in financial trouble? Absolutely not. Massive FMCG companies operate on this brilliant concept called negative working capital. They have immense bargaining power, right? They collect cash from you and me immediately at the store checkout, but they dictate terms to their suppliers, often waiting 30, 60, or even 90 days to actually pay them. So a lower current ratio in this specific context is actually a sign of supreme operational dominance, not a sign of weakness.
Now, sometimes that standard current ratio is, well, a bit too generous, and we need stricter tests. Enter the quick ratio, which is also known as the acid test. This metric completely strips out inventory from the calculation. Why? Because if there's a sudden economic shock or some localized crisis, you cannot quickly sell a warehouse full of half-assembled car chassis or massive vats of unmixed chemicals to pay your creditors, right? Inventory is rarely perfectly liquid. Even stricter than that is the cash ratio. This asks the ultimate doomsday question. Can we pay off all our short-term liabilities right this second using only the cold, hard cash sitting in the bank? IT giants like TCS are monsters here. They sit on massive cash hoards with a cash ratio of around 3, whereas most normal, healthy companies operate somewhere comfortably between 0.3 and 0.7.
Section 4, activity, which is operational efficiency. Okay, so we've checked the long-term debt, and we've verified the short-term cash. Now we need to look completely under the hood to see if the underlying engine of the business is actually running efficiently. Activity ratios tell us how fast a company is converting its daily operations back into cold, hard cash. Two metrics here are absolutely vital to track. First is days inventory outstanding, or DIO. Simply put, how many days does stock sit gathering dust in the warehouse? For an FMCG company moving soap and biscuits, it's a brisk 30 to 45 days. For a real estate developer, it can easily be 500 plus days. If you track a company and notice its DIOs steadily rising year after year, that is a massive red flag. It means old stock is accumulating, consumer demand is dropping, and they just cannot clear their shelves. Second is days outstanding, or DSO. How long do customers take to actually pay the invoice? If this number keeps climbing, your customers are delaying payments, effectively treating your business like a free, zero-interest bank. Both a rising DIO and a rising DSO will inevitably strangle a company's cash flow, slowly starving it to death.
Section 5, the anatomy of a collapse.
All right, time to put all this theory into some pretty brutal practice. We are going to conduct a financial autopsy on one of the most infamous wealth destroyers in recent Indian history, the collapse of Yes Bank. Let's see how the numbers actually warned us well in advance, long before the stock price cratered. Just look at this chronological timeline. Back in FY18, the euphoria was incredible. On the surface, things looked phenomenal. They boasted an 18% return on equity. The stock market was celebrating, rewarding them with sky-high valuations. But their loan growth was a staggering 50%. I mean, growing a massive loan book by 50% in a single year, that is terrifying. To lend that much money that fast, a bank usually has to severely lower its credit standards and start lending to desperate borrowers who probably can't pay it back. By FY19, the warning signs were flashing bright red. Loan growth inevitably slowed down, non-performing assets began to jump, and crucially, promoter pledges were dangerously high. A promoter pledge is when the founders use their own shares as collateral to borrow even more money, a massive sign of internal desperation. Their interest coverage slipped. Then came the despair of FY20. The true ugly picture was finally revealed to the public. Net non-performing assets spiked well past 5%, their capital adequacy completely failed, and the Reserve Bank of India actually had to step in and orchestrate a full takeover. The stock lost roughly 90% of its value, wiping out billions in retail wealth. But the crucial takeaway here is this. The leverage and activity metrics were screaming danger a full 2 years before the actual collapse.
Finally, Section 6, the 6-step survival check. So how do we make sure we never get caught in the next Yes Bank or DHFL? Well, here is your exact playbook. I want to give you the specific tripwires needed to completely stress test your own portfolio today. 1.
For non-financial companies, debt to equity must absolutely be less than 1. 2. Interest coverage must be greater than 3x, which proves they can easily afford their debt even if profits take a dip. 3. A current ratio comfortably over 1.5, unless of course they have that negative working capital superpower we discussed earlier. 4. A quick ratio strictly over 1. 5. Promoter pledges must be well under 25%, ideally 0. And 6. Actually, perhaps the most critical rule of all, an improving 3-year trend. A one-time snapshot is practically useless. Management can easily manipulate numbers for a single quarter or two just to look good for earnings season. But it is incredibly difficult to fake a positive, fundamentally sound 3-year trend. If any company in your portfolio scores 3 or fewer green lights on this 6-step test, yeah, it demands your immediate, highly skeptical investigation.
I want to leave you with a bit of a provocative question today. Is your portfolio truly solvent, or is it just hiding behind a shiny, profitable facade, silently waiting for its own FY20 collapse? Don't wait for a broader market crisis to find out the hard way. Take the time to apply this multi-year tracking framework to your own investments this weekend. Stop obsessing purely over earnings growth and start focusing relentlessly on survival. Because in the financial markets, if you cannot survive the bitter winter, you simply do not get to enjoy the spring. Keep learning, keep analyzing, and I'll catch you in the next explainer.